Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Missie Beach. Hey, Missy.
Hey, Casey. How are you?
Good.
You used that word already, conflict-free.
Yeah, that's right. We have seen, Missy and I have seen some crazy things in the last few weeks, and I thought, man, this is a really good time let's talk about the business of financial advice. And I always tell people that the barrier to entry, meaning the cost to get into the business of giving financial advice, is very, very low, which means that almost anybody can do it.
That's scary.
And because of that, you know, our industry is really built on trust. But because of that trust, bad things also happen. And let's break down how financial advisors make money.
Okay. Should we start with how Wiser makes money?
We can, but I think we do it the right way.
What?
So we can do that.
It's simple. Yeah.
We can do that after we talk about all the wrong ways.
Okay, let's do that because that's going to be a lot to get through.
So our industry all started hundreds of years ago, it seems like, where basically there was a trade commission. So you didn't there was no financial planning. It was just people selling shares, and they had the stories of the Boiler Room and all the famous movies have been made about it, right?
Yeah.
And basically you're selling a stock and you get a commission. You didn't care if that was the best stock for that person or not. You would want that person to come back and buy more stock, but you got a trade commission for doing it. So there was a lot of hustling, a lot of dialing for dollars, a lot of used car salesman type tactics, right?
Yeah, got to unload the shares.
Then I think more mainstream today is you have three business models. You still have a commission world there that still exists. It's masked. It's hidden a little more. Mm-hmm. It shouldn't be, but it is. Then you have this fee based world.
That's so opaque.
And then you have fee only, which is what we are. So yes, I think fee based is probably the worst, but ultimately all your big box firms, so your UBS, your Goldman, your Merrill, your Edward Jones, your Wells Fargo advisor, your Truist advisor, all those firms operate is really salespeople.
Right. But it's weird because they have to toe that line. They're playing two roles because they say they're a fiduciary because they are, but yet they're also a salesperson at the same time. So they're supposed to be doing what's right for the client, but how can they?
In a fee-based world, but on those big box firms, they're not fiduciaries.
Well, okay, that's true. They're not.
Yeah, they're not even fiduciaries. They operate under suitability rules. So if they're selling you something, are you suitable for that? I always often tell people, if you have $1 million, you might be suitable for a $1 million or $2 million mortgage. Does that mean that that's in your best interest, that you should take out a mortgage that big?
No. It
Most
depends
likely
on
not.
the whole plan.
It depends on the whole picture. But the point is that they're selling you something that's suitable.
Right, but might not be the best.
May not be the best, and they're not saying that it's the best ever. They're just saying, well, this would work for you.
Mm-hmm. Would work. Could work.
And so in that world, you see a lot of product sales. So they're selling mutual funds, and then they're getting a trailing commission for selling that mutual fund.
Or a big fat 5% load right up front.
Yes.
So you put in $100,000, they're getting paid $5,000.
Correct.
In their pocket.
Then the annuities, which we have a download on our website about why they're trying to sell you that annuity. Download that, please, if you're thinking about annuity. But on the annuity side, it could be up to 10% commission in some cases. So they're trying to sell you something that locks in your money for 14 years, costing you almost over 3% per year, most likely. Mm-hmm. And then they get a big commission. So who's benefiting from that? You're guaranteed never to lose money. You're also guaranteed never to make money. They don't tell you the latter. So all these people justify all this. These aren't bad people. These aren't people going, oh, I can go here and I can do this. I will say that something in common with that group through our interview process, when we interview people here, it's all about them. They're very self-centric people of how much money can I make?
Yeah.
That's usually the first question. If I come to Wiser, how much money can I make? That's not the first question you should be asking. So to me, that eliminates a lot of candidates because they start off with that question. But that's a problem for the client. And you have someone who smiles a lot and is happy and knows your family, and you met him through baseball, you met him through church, you met him through whatever. But in the end, they're only concerned about themselves, and the company's only concerned about selling product. Mm-hmm. That's the reality of it.
Well, and the company doesn't care about that advisor either. They're just a person filling that spot, that job opening, selling X number of products.
Which is why they hire 10 to 20 of them.
Yeah.
And maybe
Sink
one or two make it. And then the ones that didn't make it, they take those clients and move them over to the guy who did make it. Mm-hmm. Yeah. So it's a numbers game for them, and they can afford to do that. They're very large companies. So there's a false sense of security. You walk into a bank, you think that, okay, this is safe. This is a big bank, too big to fail, blah, blah, blah. And actually, maybe that's true for deposits and savings and CDs, but you get beyond that. It's not a relationship that has you in the center at all. Now, their marketing departments and their brochures make you feel that way.
Oh, sure. Yeah. All in the family. Keep everything right here.
Right. Mm-hmm. Yeah. So, having a relationship with those type of quote advisors, it can be, people think that it's normal, but it's not, in that they're not doing real financial planning in most cases. Now, there are exceptions to this, and that's when you get into, you've got $30 million and you're in the private wealth side.
Right.
Things will get very different there, because you have real planning issues that they should be working with. You might even have in-house legal counsel that's working with you on the private wealth side.
Yeah.
But for people less than $30 million in assets, you're getting sold product.
Well, and, I can think of one client that's come over recently from one of these firms where she knew she was just too small. She felt that in service, like she was part of a family relationship and she was the small fry. And she said, they just treated me like that. Like they wouldn't return my calls, promptly. Maybe a week later they get back to me. And so it was not a good feel.
Now, a lot of people left that environment and they went and created their own firms. And when they did that, they didn't have an epiphany and say, I want to start working the best interests of my clients. They just took their bad habits and they got more money for themselves because they cut out the big bank.
Yeah, exactly.
And that's the fee only model, and especially the fee-based model, which is very confusing. So they are fiduciaries in the sense that when they create a plan for you, they have to use the fiduciary rule, which is they have to disclose any conflicts of interest. But then when they are done with the plan and they move to the product, the implementation side, they're no longer fiduciaries. They operate under the same rules that they did at the big brokerage house, and now is it suitable?
Yeah. So again, the whole suitability.
Right.
Sure.
So now is the person you're working with, or when do you know they're working your best interest, and when do you know you're being sold something? Mm-hmm. I just don't understand that business model. Many years ago, TD Ameritrade came out and created a lot of ruckus with firms that use them who are fee-based, because they said, we don't support the fee-based model, we support the fee-only model. And I was like, yes,
winning.
But fee-based is definitely the most prominent. I have not seen these stats in about a year or two, but the fee-only model which is what we are, is only 4% of the industry. Wow. So a fee only model means we don't sell anything. Mm-hmm. So for us, we're getting paid as a percentage of assets that we're managing, and which is the AUM model, assets under management model. But we also have, for assets, for clients above 5 million in liquid assets with us, we convert to a flat fee.
That's unique about us, I think.
Because I believe that liquid assets above 5 million, you've got enough in stocks and bonds at that point, and we need to be looking at other things like maybe even real estate, second homes, third homes, especially when you get above 10, 15 million.
Yeah.
And so I don't want my team to ever be incentivized not to give the best advice.
Oh, exactly. Yeah. Didn't you just have a client the other week where you're like, no, take it out, buy this beach house.
Right.
Mm-hmm.
That's my favorite. That's the story I tell a lot is and he might be a listener to the podcast, so I don't want to be too detailed, but yes, $11 million net worth client, lived on very little each year, very, very frugal. And I told them that they need to go buy a $4 million beach house because you can rent it out for $12,000 to $15,000 a week, and not have as much in stocks and bonds. And so, they were very taken back by that because we lose assets under management, but we don't. It doesn't matter when we're charging a flat fee, right?
Well, a fee-based advisor would never be telling a client to take out all this money.
He'd be telling them to put it into a REIT where potentially he's getting a bigger kickback from the REIT, not the ETF REIT, but the private REIT, like Inland REIT, that would show up in the fund, right? So there's all kinds of conflicts of interest there. The other part too is on the fee only side, or at least with us, is we have an hourly rate also. So we have clients who don't have assets that we're managing directly, but we're working with them on an hourly basis. And that's growing almost a little too fast. We have huge demand for hourly planning right now, but I think it's needed. And unfortunately, quality wealth management firms won't offer that, partially because their work ethic is different. They'd rather be on the golf course and have this smooth, easy lifestyle. And I'm just a hard ass over here working everybody to death. But the whole purpose of it is that you can establish a relationship with us under the hourly. And a lot of times those people become assets under management over time. It could be 10 years, 4 years, 2 years, but they become AUM eventually.
Exactly. And these are the clients that these other firms oftentimes won't want to help because they'll be like, oh, you're too small, or you don't have enough assets yet. Yeah. And that just bugs me.
Well, for us with the airline pilots, this is like right down their alley because they're building large amounts of money inside 401k plan during their time. And right now there's a couple of firms that are hitting them really hard to manage their money inside of a brokerage link. And it just doesn't make sense. No. That's not in their best interest. That firm is not a fiduciary. That firm is very much suitability. And in the end, they're doing a huge disservice to the pilot group. And
millions.
Of millions of dollars. And anybody who's using it just can't do math. I mean, but it's not entirely the pilot's fault.
No.
That the company that's doing this is really good about disguising the true cost of what it is that they're doing. But in the end, it's nothing wrong with making money. There's nothing wrong with charging services. It's charging for services. Vanguard has lots of data that shows that individuals are better off using a financial advisor than they are not using a financial advisor. But there is a point where you cross a line. And I think that line is when you get away from the fiduciary standard, then people turn into product pushing salespeople, which is a problem. But we had a case recently where, and we talked about this in our last podcast together. We had a case with, it's a local advisor here. I love to call him out, but I can't. That wouldn't be professional. But what he was doing was he depleted her brokerage account to fund permanent life insurance and annuity sales. Then told her she didn't have enough money to be on the AUM platform and kicked her out as a client, kicked her out as the firm as a client, but kept her trailing fees from the products he already sold.
Newer from church.
And that is a fee-based advisor. that's what I have a problem with in our business.
Keeping on to the gravy train, but just kicking her out the door. I mean, a woman who needs financial planning help.
Yes.
And can't even get statements, records to show everything that transpired. So they're not even being helpful on the back end to her as they kick her out the door.
Right. And she was a great client. She'd been a great client here if she wasn't sold products that she didn't need, nor had the age or the wherewithal to even understand what it was.
Suitability.
Yeah. I don't think those products are even suitable for her, honestly, in that case, which is a whole nother issue. But so ultimately, when you're looking for a financial advisor, you have to understand what the toolbox is built of. And you might have a family member that is in that side of the business. It doesn't make them a bad person. It's just that they're working in an environment that's not set up for your success.
Right. It's your money, your dollars.
So I just get so frustrated. I don't play well in the sandbox with firms and people like that that work at those firms. Other RAs, I mean, we have whole groups of people we talk to on a weekly basis that we all support each other in the fee only world. But when they're no longer fee only, that I tend to stay away.
But Casey, even on the fee only side, I feel like there are still firms out there where there's conflicts of interest. For example, I've worked at firms before that have their own private equity funds. So they're having clients invest client money in the firm's own private equity ventures. So I'm like, that's not really keeping things separate. There's not like a Chinese wall there.
Because the private equity fund would be making money at 2 and 20.
Yeah,
that's
partners
true.
are invested in it. Clients are invested in it. That's just, I don't like that.
Yeah.
And then you want to find out if the other professionals that your firm is referring you to, like the CPA, the estate planner, the life insurance, like, are there any kickbacks?
Yeah.
We were joking the other day how much we refer out to a life insurance guy, Randy Hargett, who's in the Dave Ramsey Network.
Right.
I was like, Casey, wait, we don't even get a fruit basket at Christmas from that guy, do we?
No.
It's nothing.
No, but I've worked with enough bad partners over 23 years that we have a great group in a close network of CPAs, attorneys, and insurance people that I trust. I don't care if they never send me a referral.
Yeah.
Because my duty is to take care of the people that are here.
Yes.
And we have, 10 people a week that come through our doors kicking the tires for our services. So I'm not too worried about generating clients. I'm more concerned about servicing those clients.
Yeah. Sending them off to good people.
Quality over quantity for sure.
And that's what makes it easy to help our clients. We'll say, here are these resources and, use them if you want to. Lots of clients have used them in the past. We've gotten good feedback. But if you don't want to use them for life insurance or whatever, hey, go use whoever you want to. But if we are telling you that there's a life insurance gap and you need it, we're not selling it to you. We're not getting anything out of this deal. So we are just giving you advice. So you really need life insurance. Go find someone else if you don't like our picks.
Correct. Another thing I would suggest people do is go to brokercheck.com.
Oh, yeah.
You've got to look at the background of the advisor.
Explain a little bit more like what that is, because that's a gold mine.
It is. So you have FINRA, which regulates brokers, and when they mess up, it gets reported on BrokerCheck. So basically, there's a advisory firm next door to us in another building that irritates the crap out of me that they're even there. Because when you look him up, he has 2 judgments against him where he had to pay $25,000 fine for selling products that were not suitable for the investor. Now, FINRA is made up, it's a self-regulatory body. It's made up of its peers. So basically, he went before a panel of his peers who tried to protect him.
Yeah.
Right? I mean, there's whole articles in the last year in the Wall Street Journal as if FINRA broken, because a lot of these guys are getting fines, but then it doesn't get on the record. They're able to negotiate.
It's expunged.
Expunged from the record. So you paid $50,000 in a fine, but it won't ever show up on your record. It's kind of like getting
dirty.
Like a speeding ticket. You pay an admin fee, but it doesn't show up on your, and that's fine for speeding tickets. But when it comes to the brokers, that shouldn't be that way. So this guy has two $25,000 fines. It says he paid. And anytime you see that, that's huge. If it got that far, that means that it was probably way worse than what it's written, how it's written in broker check.
And more than one. It wasn't some one-off fluke that went haywire.
Correct. And sometimes you'll see complaints. So if you see one complaint, it's kind of like you fly on an airline, you had a really bad experience. Do you know how hard it is to figure out how to file a complaint against the airline with the FAA? When you go to FINRA and you have to it's not an easy process.
No.
So you are just really angry or have been really damaged.
Oh yeah.
In this place, it'd be like going to the bar association with an attorney.
Oh yeah.
Right. So in the end, you should probably you have to at least read the disclosure to say, okay, well, what was the problem? There is a chance that some deranged person goes and files a complaint, and there's not much you can really do about it. Hopefully you have a really good attorney and you head that off. We have an arbitration clause for us. Never had to use it, but we have an arbitration clause. We don't go before FINRA. We go down to the courthouse. That's why I tell people is we're not in the boys club.
Yeah, I know.
As fiduciaries and fee only people, if we get in trouble, we're not going to FINRA, we're going to the courthouse. And that's totally different. So broker check. Another one is, and I'll call them out, is Edward Jones Advisors. Edward Jones trains their advisors to be really aggressive in sales. Very aggressive.
They've knocked on my front door before.
Yeah.
At home.
At home. That's crazy. So they train to be very, very aggressive. So if you have a seasoned Edward Jones person, my bet is at least 8 complaints. Is that what you want for a financial advisor? Do you want an advisor that is pushing product to the point that his client base is angry and people leave? I mean, that's
in his defense, he's only doing it to make quotas to feed his family.
Yes.
So,
yeah.
But that's what that dark side is pushing their people to do.
Yeah, exactly. Every time I see or meet an Edward Jones person, there's one I met recently. Man, what a nice guy. We had a great conversation. I had no idea he was an Edward Jones guy. No idea. And then it just so happened, he asked what I did, and I told him. He goes, "Oh yeah, I do the same thing." I said, no. I was thinking he was going to say Signature FD or somebody like that, right?
Same thing.
And he's "Oh yeah, I run an Edward Jones shop, and I've been out, but I know your name because I have a friend of mine who I've been trying to get into my firm." But he says, "No, I have a good financial advisor. His name's Casey Smith." And I knew who the guy was, and I was like, "Oh my gosh, like I know who you are now. This is crazy." Very nice person.
Yeah.
But I just feel sorry for him because I'm like,
no, they're not out to do bad.
No, they're doing exactly what they've been trained to do.
Yeah, exactly. I mean, they're good people.
So
They're just not.
But it's not the place that you need to have your money.
No, absolutely.
Especially if you have more than $500,000. There's lots of choices in Atlanta for $500,000 higher. Edward Jones I always felt like was more of, if you have less than $500,000, $25,000,
I was just going to say, if you have $25,000, go to Edward
and you don't
Jones.
know how to go to Vanguard.com. We created a whole process or a whole product just for that. It's called Flight Path, where people can invest in a automated investment service. It's our portfolios, but it's abbreviated. It's very we call them core asset allocation, 0.5% a year. That's partially created just for people who are targets of Edward Jones. They can come in for hourly financial planning, still get full advice. And I think the savings account's at 5.25% or something like that now.
Oh, yeah, it's crazy. The betterment.
For new people, I think 4.5 for everyone else. But yeah, that was created just to create a service to rescue people from that environment. Other people that have been aggressive has been Morgan Stanley. I would say that there's so many different levels of that company.
Oh yeah.
But
Figure out.
many years ago, we had to fight off a guy who, he ended up friending a widow, which widows have a special place in my heart because they are targets. Mm-hmm. He managed to work his way into her will. She had no children. Her husband passed away. She outlived all her friends. All her money was supposed to go to Emory. Mm-hmm. And the Morgan Stanley guy, we got wind of it from a caregiver who looked us up online and said, hey, I'm a caregiver for this lady. This advisor's really aggressive with her. Could you come and talk to her? So we literally go and talk to this lady who hardly knew we were coming.
Yeah.
She's like 90 something years old. And we basically said, ma'am, understand that you might be looking for a new financial advisor, that, your current, and I said something along the line of, is your current financial advisor also a beneficiary of your will? And she was like, well, yeah, he had me change it. I was like, oh, Lord.
He had me change it.
So we changed her estate planning back.
Oh, really?
We moved the money here. Mm-hmm. Within 2 days after it got here, he went back to her, strong-armed her into moving the money back.
No. Oh, poor lady.
Then a few months later, she passed away. Mm-hmm. He sued over the will.
He sued the estate?
Yep.
Oh my gosh.
And he ended up getting half the money because Emory was like, look,
not worth it.
We can fight it.
Or we could just
and we win, but if we settle with them and get half, then we won't spend that in legal fees, and actually we could use this for a project.
Yeah, just take the bird in hand.
Isn't that crazy? And so we filed a complaint with, he was a certified financial planner. Filed a complaint with the CFP board. Nothing happened. Not one single thing happened.
Holy cow.
This is why I don't. CFP is a great designation. I require it for all of our employees, but I don't put a whole lot
of discipline process.
I don't put a whole lot of faith and trust into the CFP designation because of that. But they did nothing. Then we ended up. The attorney on the time did some pro bono work and trying to defend it, and ended up getting settled that way. But yeah, it was. He did. Oh, we did contact Morgan Stanley directly. He was terminated. Oh. But he went to an independent fee-based firm, and I'm sure is up to his same tricks. His address was on West Paces Ferry. So I can only assume, and there's no tiny house on West Paces Ferry.
Not.
I can only assume that this is a pattern with him, and over and over and over again. But he would come by and get her mail every day, check her mail. He was looking for stuff. Wow. And so anyway, it doesn't mean they're all like that.
No, but
that's what you have to look out for. There's been guys that we've talked to here that were part of a Ponzi scheme. A guy went up to Cobb EMC and talked to retirees, and he promised everyone a 10% rate of return.
Yeah, these things just aren't in New York, in big cities. They're all over America, getting at the middle class,
right.
Just regular people.
So in the end, you have to be so careful about who you trust your money with. Mm-hmm. And just because they're at a bank or a Morgan Stanley or wherever doesn't mean that they're outstanding people and they're really working your best interest.
No, there's no halos over their heads just because they've got like a big institution behind them.
So and those big institutions, if they're a big producer, they will keep them on as long as possible because that bank knows they're making a lot of money. Mm-hmm.
It's worth the tiny risk that they'll run afoul of something. Mm-hmm.
Correct. And that's what I see with our neighbor over here. Every time I look across, I'm just, God, I got to look like
I'm going to go look that up when we're finished.
Yeah, it's crazy, but broker check is a great way to try to get ahead of that. But just know that there are a lot of ways to mitigate things off your record. So it doesn't always mean that. But yeah, if you're getting a lot of mutual funds inside your brokerage account, if you are getting pushed to purchase annuities, those are all red flags. Mm-hmm. that you don't have a person. And financial planning. So very few firms do real financial planning.
No. A
So-
lot of times it'll be a one-time thing.
A one-time thing, a free thing, which is crazy. We're interviewing people now to join our Wiser team, and interviewed someone said, yeah, we don't charge for our financial plans. We do it for free. But they also sold annuities. So they're doing plans for free to get business to then sell product.
Yeah.
That's a huge red flag. And then a lot of people who think they do planning don't really do planning. They're only doing time value money calculations and only calculating things for retirement. So if all you did was a retirement plan, so all you focused on was, this is how much I have, this is how long it'll last, that's not proper financial planning, I should say.
No, it's those that are anchoring on what's my number, because I just have to get to the goal line and
Correct.
hey, then life is great.
So there's this whole other aspect to financial planning that most of these firms aren't covering. Property casualty. Now, they probably cover life insurance because they want to sell it.
True.
But life insurance, estate planning, tax planning, those are all things that are done at a wealth management firm.
That are ongoing too. It's not a one-time thing.
Right. In our review meetings, we talk about portfolios and rates of returns for maybe 5 minutes. And the rest of the time is spent on the big picture of tax planning, estate planning, insurance planning, right?
Yes.
All those property and casualty. Umbrella. People get an umbrella policy. We have so many clients that don't have proper umbrella policies. So it's to me, there are many firms that do what we do. Many firms. They're just hard to find.
True. Yeah, they're few and far between.
I think we get so many clients because of our digital marketing, but most of my friends that are good advisors aren't doing digital marketing. They're just kind of sitting, waiting around for someone to call them, and they get client referrals and they grow, and that's how it usually happens. And there's nothing wrong with that. But ultimately, you have to make sure that an advisor is fiduciary and fee only, because on the bottom of my email tag, I have fiduciary plus fee only equals your best interest, which is very true. But
absolutely, Casey. Fee only. It's just simple, straightforward, and that's all you're paying.
And then, I think we like to add a custom aspect to that, because there are some large fee only firms now do acquisitions.
True.
But you kind of feel like a number.
Well, that's why I'm here and not at a large firm, because I was not going to be, doling out to just a number, client number 2497 today.
Right. Exactly. But thanks for listening to my soapbox on this. We kind of go through fits where I feel like everything's great. And then for whatever reason, in the last few weeks, we just seem to be interacting with one bad apple after another. And so this is our public service announcement. Just
trying to help the orphans of the storm.
That's right. Just be careful out there. There's a lot of greedy people.
It's a rough world.
Thanks, Missy.
Thanks, Casey.
Hey, before we go though, episode 118, take a look at that. What to look for in financial advisor. Episode 143, financial success is intentional. You need a good team to build around you to be financially successful, and we want to be a part of that. YouTube, we have a YouTube channel, A Wiser Retirement. We have 2 linked here in the show notes: financial planner versus financial advisor, and avoid this annuity salesperson. 2 short videos I did for you as a bonus feature to this podcast. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, or want to schedule a consultation to meet with one of our fiduciary financial advisors, that's important, Missy, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Thanks for listening. This podcast continues to grow. If you have a minute, please, wherever you're listening to the podcast, if you will give us a great rating, that helps us grow even further. Have a great week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.